All right, Erin Browne, Pimco, let's get a little bit of your playbook as we end the quarter, we head into a new one, and why you say China offers a safe haven right now.
Sure. So I still think we're in a market environment in the U.S. where we're likely going to grind higher and then gap lower. And we're still climbing a wall of uncertainty with respect to the stock market. So I think it's okay to stay invested in certain high quality, more defensive oriented stocks in the U.S. But where you're looking to get more of your sort of juice in your portfolio, I think you really want to turn your attention to emerging market stocks and specifically to Chinese equities, which are have really decoupled largely from the global economic cycle and are really operating on a reopening story that I think is going to really fuel further outperformance. Chinese equities have underperformed, relative and done a little bit poorly in the first quarter of this year. So I think you're actually getting in at a much better time today than you were, as we turn the page into 2023. And I think that looking at more of the service-oriented stocks that are really going to benefit from travel and reopening in China is where you want to place your bets. And these stocks are still trading at valuations which I think are compelling. And what's important is that the growth that you're starting to see accelerate in China is not yet priced into the share prices of these names.
I want to go back to what you said at the outset. Grind higher, then in your words, gap lower. That doesn't sound great. When does all this transpire?
Well, we've seen it over the last couple of weeks, right? Even as we went through the banking crisis, we've been grinding higher since the beginning of the year and then had, obviously banking turmoil sort of put everything on its knees, and we saw a gap lower in the equity market. Now we're sort of grinding back to new highs or new levels, but I think that we're not out of this risk period yet for equities because we are heading into a recession, which is likely going to come before the end of the year. And in those environments, you typically see more volatility in equities. You start to see credit underperforming, which we've seen year to date. And we're starting to see a lot of these sort of pieces line up that make me concerned about, being very risk on in my portfolio right now, particularly as we head closer and closer to recession and we start to see more breaks and cracks in the system.
You surprised, though, at how resilient the market has looked and acted since the whole SVB thing went down?
Yeah, but I think it's really a tale of two markets when you look and decompose the equity market performance. You've had Russell, 2000 companies, small cap companies, which have underperformed meaningfully year to date versus, or at least over the last month, versus, sort of large cap equities and the tech sector, which is 20% off its, December lows. So there's been a real bifurcation over the last month where I think the market's actually appropriately discounting the risk in the more vulnerable parts of the equity market, the smaller cap companies, the ones that don't have as much liquidity or access to capital. Those are starting to underperform, and I would expect that they'll continue to underperform, throughout the rest of the year. Those companies that are large cap, that are maybe not as reliant upon regional banks in terms of their lending and have more access to different liquidity levers, have meaningfully outperformed, like the tech sector. And I would expect that bifurcation in the market is going to continue to persist as we head closer to a recession.
All right, Erin, we'll talk to you soon. Erin Browne.